And welcome, everybody. It is June 17th, and it's Tuesday, so it's time to do some Trillion Dollar Show. This is the show where we talk about how to save Americans $1 trillion in taxes. Because I don't know if you guys have been following the latest out of Congress. There was a vote on the Doge cuts, so I think they cut like $9 billion or something like that out of the first it was going to be $1 trillion, then it was going to be 250 billion, then it was like 125, and now it's 9, which is, better than zero, but not not what we were promised. So when you look at the causes and effects, there is no political solution to reducing spending. And so the only way to constrain Congress is to give them less, which means keeping your tax dollars for yourself. Now, at the same time, I don't know about you guys, but I would much rather hold on to my own money rather than hand it over in taxes. So it's a win-win. We help preserve the dollar itself as well as keep more money in our own pockets. So that's what the Trillion Dollar Show is about. It's our mission to spread tax planning to everybody. And obviously, we can't take everybody's clients, although I wish we could. But we can spread the knowledge of different ideas when it comes to taxes and small business and everything. Because if I could just tweak every small business in America, we could get to that $1 trillion no problem. But that's hard to do. So that's why we're here. All right. So I'm Neil. I am the founder of Tax Sherpa, and with me is Serena and Fatma, two of our executive team. So they are the ones who make things happen behind the scenes. And yeah, so on this show, typically we'll just do a couple news and announcements things. I do have some news stuff to share, and then we'll just run through some questions that have come in over the past little while because we get constant questions. And the answer is always, it depends. And
Yep.
it depends on what we call facts and circumstances. So what is true for you might not be true for the person next to you, just because their facts and circumstances are different than your facts and circumstances. So this week I've been posting on LinkedIn about travel. And travel is one of those things where intent really matters. So if your intent is to have a business meeting, then it's at least partially a business expense. If your intent is vacation, then no. So, it comes down to like what is going on in your mind. And the same is true of a lot of different things. It's like what is your purpose in doing this thing? And how do you prove a purpose? Well, it comes down to documentation, really. If you can show that you planned ahead and you had this business purpose in mind, then that's your substantiation. That's your proof. Uh, but there's a lot of things that come up like that. But maybe we'll get into some of that later. Before we get there, let's talk news. So we finally got the Senate. They didn't do the vote like they said they were going to two Fridays ago, but they did release text of their version of the Big Beautiful Bill. So the House already passed their version. The Senate is deliberating and will probably pass some version on their side. And then because the two are different, they'll have to reconcile the two and then send it off to the president for signature. Now, originally they were talking about getting it done in April, then they missed that deadline. Then they said Memorial Day, but they missed that deadline. And since Memorial Day, they've been saying they want a July 4th ceremony, signing ceremony. And, we are 2 weeks away from that. So maybe that'll get done. It is a festive occasion, anniversary of the signing of the Declaration and all that kind of stuff. So, it's pomp and circumstance, whatnot. But a couple things to highlight in differences between the Senate version and the House version. So, a couple things. So, one is the QBI deduction. So, the QBI deduction was created back in 2017 with the original Tax Cut and Jobs Act. And this is a tax break on pass-through income from various types of pass-through business entities. It's a great deduction for small business people. And the House version had made it permanent and raised it to 23% potentially. And the Senate version makes it permanent, but keeps it at 20%. So that's something that will need to reconcile that 20 versus 23%. People have heard about the no tax on tips, no tax on overtime thing. In the House version, there was no limits on that. In the Senate version, there's a limit of 25,000. It also depends on if you are under a certain income threshold overall. Um, The senior no tax on Social Security, not in either version. The House version had a $4,000 extra deduction for seniors. Senate version had a similar kind of thing. I think the number differed a little bit. Tax credits for kids, child tax credit. They both versions expand the child tax credit, but there are differences in numbers as far as how much they're expanding and how many years they're expanding it for. Um, let's see what else was in there. The MAGA accounts are in both versions, and I didn't see any substantial differences between the two on the MAGA accounts. So this is where for newborns or people under 8, you can open this account, which is a trust account of some sort that's going to be invested basically, from what we can tell, in index funds of the stock market, of American stock market. So if you open it for a newborn who is born after the passage of this thing, the government will kick in the first $1,000. But anybody can open an account for, assuming this passes, can open an account for anybody under 8, and they can contribute up to $5,000 a year. And there's a little bit of confusion that's going on already, is that you can open it under 8, but you can contribute the 5,000 until they're 18. And then once they turn 18, they can use it for college, they can use it for first-time home buyer, they can use it for acquiring a business, which is an interesting one. That's, we'll see how that all works out, in 10 years' time. But it's basically a supercharged 529 plan, essentially, which is, the college savings framework. Let's see, what else was in there that struck me as differences? It's 549 pages, so there's a fair bit of stuff in there. But those are kind of the highlights that stuck out at me as far as the tax provisions go. And there's a lot of other provisions in both versions, like they're making a lot of the Tax Cut and Jobs Act things that were supposed to expire at the end of 10 years, they're making those permanent. So like the no personal exemptions, the change in itemized deductions, the change in the standard deduction, the change in casualty losses, all this kind of stuff is basically just being entrenched as like the new permanent way until we get another tax bill in another 10 years, because it's about every 10 years we get a new major tax bill, just kind of historically. There was a 76, there was an 86, there was, can't remember the one in the 90s, but there was like 2004, and then we got 2017. So, it's a pretty regular thing that the tax law gets completely changed. So that's sort of the announcement for the moment, and or the news, I guess. We are coming into the end of June, which means quarterly payroll stuff is coming up for all you people who run your own W-2s. And it's worth noting that W-2 withholding, I've made a video about it, but I can't remember the code section. Is it 16654 2F2? I think that's right. As far as the citation goes, is that the withholding that you have through your W-2 gets spread throughout the year evenly, regardless of how it was actually paid. So it's an interesting little hack that sometimes you can hold on to your cash better by paying later in the year through W-2 rather than through estimated payments. So there is that. I think that's all the announcements and news I had for the moment. Serena, did I miss anything?
Nope, you got it right. Everything. You didn't miss anything. But what's your favorite new kind of rule that's going to be possibly set in place? What's your favorite one?
Yeah, well, I mean, my favorite is definitely the MAGA accounts
Mm.
or the Trump accounts. It kind of goes under both names. Um, so if you have a newborn in 2026, let's say, um, you open the account, the government kicks in $1,000. They go through age 8. At age 8, you continue contributing to the $5,000 a year, and then they start to get on payroll. Once they're on payroll, you have them contribute to either traditional or a Roth IRA. And in 2027, from the Secure Act, there's a new tax credit that's going to effect. It's a replacement for the retirement savers account or retirement savers credit. So under the old version, uh, you got a credit if you were below certain income thresholds and you had tax liability, you would get a credit for the amount you contribute to retirement plans because they're trying to encourage people to save for their own retirement. Under the new version, starting in 2027, there is there's a credit up to $1,000, and it is refundable, meaning that even if you didn't owe any tax liability, the government's still going to kick in $1,000 and it's going to get paid directly to to your retirement account. So let's say you have that 10-year-old now, you've been kicking in $5,000 a year, and now he's on, has a Roth IRA. He puts in another $7,000, let's say, maybe, and the government kicks in another $1,000 a year based on this new retirement credit. And basically, by the time you get to retirement age, when you're 60 or whatever, you have millions of dollars in this account, as long as, well, assuming a couple things, assuming the financial system of America remains intact, assuming that the the kid, who will then be a grown up, can resist tampering with the account. That's actually the biggest problem. But if you just do that from birth through 18, and obviously it takes money to make all this work, so you got to make enough money to make it work. But if you could do that, you could set your kids up for massive success later. So that's my favorite tweak of all this stuff, is the combination of those different things.
Sounds good. I feel like I just gave you a question.
Yeah, well,
Hey, should I pass it over to Papa now?
we can do it either way.
Okay.
I'll answer anything.
Okay. Ready to go ahead, Fatma?
All right, so boss, if someone's just starting a side hustle, when do they actually need to worry about taxes?
When you're making money. So if you're starting out a side hustle and you have yet to make a sale, don't worry about it. Make money first. And if it becomes something that you can see turning into something larger, then it's time to have those conversations. So, there is a what do I call it? There is a course I put together called the Starter Course, and it's all about it kind of diverges into two tracks. It kind of gives you a little bit of basics, and then it says, okay, if you have a day job and have a side hustle, you go to this module, and if you're just full time in your own thing, go to this module. So the thing about side hustles is that, once you are doing something with the intent of making profit, that's, again, it comes back to that intent thing, is that then it allows for potentially more interesting tax strategy. Because if you just have a day job where you're working for somebody else, you get a W-2, and that's it, there's very limited things you can do. I mean, you can contribute to an IRA or a 401k or something like that. You can contribute to an HSA. That's kind of, there's like a couple of basic standard things. But once you have a business, it becomes a lot more interesting, and you have a lot more flexibility is what you could potentially do. Like, the travel I was talking about earlier. So, you can turn travel into a business expense as long as business is the primary purpose. And what that means for you, well, it depends on what you're doing, right? So, there are things to think about at that point. But if you're just getting started and you don't even know if you can make a sale, then don't worry about it. Make some money first, and then we can, even if it's just the first $100 or whatever it is, if you can start to have that intent and show that you are trying to make money with this, then it's time to worry about tax stuff. Because, not necessarily owing taxes, because if you made $100, your tax bill is going to be very little. But you can potentially leverage that to your advantage to actually pay less in taxes. So that's where it starts to get, interesting.
Alrighty. Looks like we have a spicy question coming in. Someone wants to know a spicy question. Someone just wrote and said, Neil, what's one tax strategy you secretly hate, but everyone asks for?
That's
It's so spicy.
Yeah, a little bit. So actually, this one is probably the home office deduction. So the home office deduction is one of the highest audit risk things you could do. Now, in the current environment we find ourselves, half the IRS has been laid off. Just yesterday, the DOJ budget for criminal enforcement on tax was cut. So, your audit risk in general right this second is probably lower than it has been for your living memory. But in general, the home office deduction, can only be done with a Schedule C business. So Schedule Cs by themselves are higher audit risk compared to other business types. And the home office stuff, it's the home office and the vehicle. Those two combined are what, the IRS highlights as, the tax gap, as far as, the largest elements of abuse. And it's not that it's not that the strategies or that the deductions are illegitimate, it's that people abuse them, right? And because other people abuse them, that means you get put in the bucket of high risk. So I would much rather take those same or similar types of expenses through an accountable plan, a Section 162 plan, rather than through home office deduction. And that means, having a more professionalized business setup. And there are pros and cons with that, but the pros are your audit risk is way lower, and I don't think you need any other pros. That. The cons are it is more complicated to administer, so there's that. But if you keep track of your numbers and you do the things you're supposed to be doing as a business owner anyways, then you get the even more bang for your buck out of a 162 plan versus a home office deduction. So the thing with the home office deduction is that if you create a home office, there was a court case that established that I'm forgetting the citation off the top of my head, but there was a court case that established that, the home office being your place of business means that your travel from your home office is business travel, assuming you have a business purpose, right? It's not a commute. That's the important distinction, because your normal commute is not deductible. So I remember I had one guy, it was back when I was working in Florida. He's a transplant from New York. So he comes in, he brings us his taxes, and this was back in the days when we could deduct unreimbursed employee expenses. So this is before 2017. And I was looking at his old tax returns because we always ask people to bring in their last three. And he's got like $8,000 worth of tolls for unreimbursed business expenses. I said, "What is this?" And he says, "Oh, well, that was my bridge or bridge or tunnel tolls, going into the city for New York." I was like, "Yeah, but that's just what you did every day, right? That was going from home to work." He's like, "Yeah, that's what I paid to go to work. So it was a a work expense." I was like, "No, you don't
Yeah.
get to do that if it's your normal commute, because the sort of presumption is that you get to pick where you live. The fact that you happen to pick a place where you have to pay a toll to get to where you're working, that's on you, right? You could have lived somewhere else. And so your normal commute from home to work is not deductible. From home to work and then from work to home, not deductible. But by establishing the home office, now you have a place of work, and then going from that place of work to elsewhere is deductible, right? As far as mileage or actual expenses, depending on how you want to do it. And so what happens is that people do crazy things with their vehicles, and they'll write down. I was looking at somebody. They had like 200,000 miles of mileage on a Schedule C, and it's just insane. And so, I've had clients that drive a lot. I had one guy that was a liquor sales rep for the state of Florida, and he drove 46,000 miles every year because he had to crisscross the entire state like constantly, and he had to get a new car every 2 years. And that again, that was back in the days when we could use that for day jobs. So that's about the max any one person can drive. The idea of driving hundreds of thousands of miles and you're not a truck driver um, is ridiculous. So it's those abuses that dovetail on a Schedule C that's already abused because the people who file Schedule Cs don't have good advice because they're trying to do it themselves. All of that culminates into a very high risk tax position that you put yourself in. And so that's what I would prefer people not do, and do it in a better way, a safer way, to not put themselves in the bucket with those crazy people. So that's my least favorite thing that people ask about.
Well, thank you for answering the spicy question.
Yeah, so for my next question, boss, what is the difference between tax prep and tax planning? Like, what are people paying for?
Oh, that's a good question. Let me bring up the little checklist that I made. See if I can actually find it. Every time I try to log into Google and for my files and stuff, it's always like, prove that you're you. I mean, I have like 23 Google logins, but that's not the point. Tax. What did I call it? Did I call it checklist? Self-check. That's what I called it. There it is. Okay, so the difference is, let's share screen here. All right, the difference is, one is reporting the facts, and the other is planning ahead to make the facts in your favor. So a lot of people think that they're getting tax planning when in fact they are getting compliance. So in the tax pro business, there's the compliance work, that's filing the forms and filling things out and making sure everything's accurate. And then there's the planning work, which is, what can we do? What strategies can we implement? And some compliance filer people will kind of mention some stuff. It's like, hey, if you contribute to your IRA, or if you did this, or if you did that, then you could save some money, right? But that's kind of like the limit of it. So what this self-check does is it goes through and you just kind of score yourself like, I did this, or my tax pro does that, check, check, check. And you get a +1 for each one of these things. This is the basics. Strategic tax planning, these are the kinds of things that we look at, proactively identifying tax saving opportunities, helping you plan for major financial decisions. Hey, I'm thinking about buying a house. I'm getting married. I'm getting divorced. I'm, whatever. I'm hiring employees. Communicating regularly throughout the year, offer advice on entity structure, retirement plannings, wealth building strategies, helping you understand the why. Because, so a lot of the stuff that I am going through here is trying to explain the why of things so that people can understand how things might apply to their situation, right? Actively looking for ways to minimize your tax liability. And that's basically what I do all day, every day. And then the red flags. If you get one of these, then this is actually a -1 score. And so you just count up, whatever your score is. And then there's little score area, room for improvement, mixed, maybe you're getting a little bit of planning. And then, if you're over 6, then you're getting a good planning situation. So, so the difference comes down to, are you filing things, in a look behind kind of way, because, taxes are filed the following year for the prior year, or are you operating this year trying to figure out what we can do now in order to alter that filing in the future? So that's the fundamental difference between compliance and planning. So look behind, look ahead. And the look ahead has way better results, I'll tell you that. Oh, and if anybody wants that checklist, just send us an email at office@Tax Sherpa. We'll send you a copy.
So just being proactive, right, Neil?
Yeah, being proactive. That's fundamentally it. If your relationship with your tax professional is, at the end of the year, you hand over your papers and say, here's my stuff, and they fill out the form and they say, here you go, then you're not getting tax planning. You're getting compliance, which has to be done, right? It has to be done accurately, it has to be done correctly, and all this kind of stuff. But that is the end of the process, not the main part of the process when it comes to planning. So, we're talking to clients now about, it's like, oh, well, what should your payroll be if you're paying yourself from your own business? There's a mathematical answer to that, and it depends on what else is going on in your life. If you're looking at, we were talking to a guy yesterday, and he was talking about buying a new business, and it's like, well, what kind of things do we have to think about in his particular situation for the, well, what are the considerations? Should it be a C Corp? Should it be a pass-through? And he's already got a management company set up. Should whatever acquisition he does, should it pay that? All these different kinds of things that we work through on an individualized basis. But that's the kind of things that you get with actual planning rather than just compliance.
So you would say the same amount of time that you spend with your financial advisor should be the same amount of time you spend with your tax advisor.
That's a good question. Maybe. Yeah. Because, I mean, for most people, especially small business people, their largest single expense is taxes. So whatever you can do to alter that number is going to have a large impact. And, I always wish that when we generate tax savings for people, that they take that money and invest it for the long term and all this kind of stuff. Realistically, rarely happens. Most people use that for operating capital, or they just spend it, or whatever. I had one guy who bought a boat after complaining to me all day, when we were filing his taxes, that he was, broke and everything. I've had other people say, tell me, sitting in my office saying, it's like, well, I need like this amount of money because I'm taking the kids to Disney. It's like, well, you're just complaining to me that you don't have any money. Why are you taking the kids to Disney? Because, Disney's expensive. Even back then, when that was having that conversation, it was expensive. So, it's ideally, the perfect scenario would be you do tax planning, save a whole bunch of money, take that money, work with your financial advisor, invest that money, and generate yield over time. That would be ideal. And then that lightens up the load that you need to generate in terms of active income, because your passive income will grow and grow and grow. Now, I'll put passive in quotes because there is no such thing, but dividends, triple net leases, these kind of things are pretty much as passive as you're going to get, and they still require management, but it's less than operating a business, for example. So yeah, that'd be the ideal situation.
Understood. So we have a question that just came in, and it's funny because you were just talking about this on LinkedIn. But someone wants to know, is it true I can write off my vacation if I talk about business on the beach, or is that just a social media hype?
Well, it's a little bit of both. So over the past couple of weeks, I've been trying to make an effort on LinkedIn to do like a theme of the week, right? So this theme has been travel, because we've been getting all these travel questions, and it's summer, people take vacations. So what makes something, just as a broad principle when it comes to business, what makes something a deduction is that it is done with the intent, again, there's that word again, the intent of pursuing additional profit. Doesn't mean you have to make profit, but you have to intend to. And I always use the story of this place around the corner from me where they opened a new store in a shopping center. It was pour your own popcorn of different flavors and then, weigh the result and you pay by the weight. And they opened up, they had shiny machines. They look like big gumball machines, like with the globe thing, but they were huge, because they're holding popcorn. And I never saw a single person go in there. I would just pass by it on the way to the grocery store. And 3 months later, it was gone. So, obviously they intended to make some profit. This was a real business that they invested real money into, but they obviously did not do well. So they lost money, but it is still deductible losses because they intended to make money, right? If you have a horse that you spend a lot of money on just for fun as a hobby, that's not deductible because there's no intent to make money there. If you are a horse trainer who trains horses for, Belmont Stakes or whatever, that is deductible because there's an intent of making money, right? So same thing applies to travel, right? If there is an intent to do something that improves your business, then that makes it deductible. So if you are having going to see new production facilities, if you are having meetings with your staff, if you are having an off-site retreat, or if you are pursuing new clients, or if you are doing content about, if you're in a content type of business where you have like advertising collateral that you need. So those are all purposes of improving your business, and that creates deductibility potentially, right? Personal stuff while on vacation, not deductible, even if the overall purpose is business. So let's say you go to the beach for an offsite retreat with your staff, and the purpose of the offsite is to get together and to just network with each other, develop business strategy, vision for the future, all that kind of stuff. But then you book a personal snorkeling trip during the vacation. That snorkeling trip is not deductible because that's personal, right? If you did it with potential clients as a way to, improve your brand recognition with those people, then maybe, right? So, it all comes down to the specifics and the intent behind them. So those are the same principles that apply to travel and most things when it comes to business deductibility. There are some caveats along with that as far as like extravagance, necessary and ordinary, and all these kinds of things. So, like, if there have been court cases about like extravagance as far as like, well, you chose this option, but this other cheaper option was available, so you should have gone with that, and therefore we're going to throw out your more expensive deduction. So things like that do happen, but as long as you are in the reasonable ballpark for whatever it is you're doing, then you're reasonably safe. Now, like everything, when it comes to risk factors, the thing about audits is documentation, and people are terrible at documentation just across the board. So you know, if I actually made a little itinerary, like a 3-day itinerary template that people could use. I actually made that this morning because it was tied to that post on LinkedIn. But if you have that, contemporaneous, that's a key term, contemporaneous, meaning at the same time as, developing the travel plan overall, then that's a strong point in your favor that the intent behind this was business in the first place, rather than trying to, make up something after the fact. So um, just follow the rules, intend to have a business purpose that will improve your business in some form or fashion, document that fact, and then you're in good stead. So that's what it comes down to. What's in your brain?
All right. So for my direct question, boss, if someone has multiple streams of income, how do they keep from getting hit with a huge tax bill?
Well, it depends on how big those streams are, but yeah. So if you have streams of income, with the exception of C corporations, pretty much everything comes home to you, and you're going to pay tax on the conglomeration of those different income sources. So it really comes down to what are the character of those sources? Are they active income? Are they passive? Do they carry self-employment considerations or do they not? And then, what things can you do? So, there are in the secondary world of what I call the exotics, there's a million different strategies out there. People will take your money in order to generate, different tax positions, but fundamentally they all require you to have economic risk, in order to offset things. So I mean, there's things like that you can do, um, but it's in the aggregate. If you're paying more than, I don't know, it's hard to pick a number. But if you're paying more than 20, 25, 30% in tax, like you're in those upper brackets, then almost always there is something you can potentially do in order to, reduce your tax exposure. But without like specifics with a particular person's situation, it's hard to give an example. But I'll throw out a couple just in case. So real estate is a common one. Someone has commercial real estate or a portfolio of residential real estate. A lot of times a cost segregation study can be helpful, right? Because you can bring depreciation that you would have had over a long period of time into the current year and then expense that against the income that's being generated now. As in case I didn't mention it before, part of the big beautiful bill is to make 100% depreciation, bring it back, and the Senate version makes it permanent rather than giving it another 5 years. So that could be another thing. The Senate version also has if you invest in building manufacturing facilities in the U.S. after the passage of this thing, then you can actually expense everything in year one, which is crazy. But you're getting basically 40 times the write-off in year one compared to the old system in those situations. So it's that could be a big deal for anybody who's in manufacturing. Anyway, so like if real estate is part of the streams of income, then there are real estate strategies. If you have passive investments that you're like a limited partner in, then that's going to be a different bucket of things because there's different considerations with passive income. If you are an active member of a company, whether it's your company 100% or maybe 50% or whatever, then there's a different bucket of considerations with those. So, it really depends on the mix and depends on the totals as far as the things that you have available to yourself. But yeah, it's just a whole lot of it depends. Oh, Serena, you're muted.
I apologize.
There you
Okay.
go.
Sorry about that. So, people, ask this question a lot, Neil, but can they pay for student loans, from their business, like things they pay for the school, like college? Can they pay for that?
Yeah, so during COVID, Section 127 was amended to include student loan payments. So
Oh,
if you set it up correctly, you can pay up to $5,250 per person, per employee or common law employee, towards student loans, and that can be done basically as a tax-free benefit for the employee. So yes, you can under provisions up to that 5,250 amount. So yeah, you can make that work. Before COVID, that was not one of the permissible uses of Section 127. It used to be only for active education. So like you could pay for somebody to go to school or to go to training or whatever. But that was changed a couple years ago. So yeah, that does work. If you do that though, you have to be mindful that the student is not allowed to double dip, or the former student, so you can't get a tax-free benefit from your employee and then write off the interest of that payment on your student loan deduction for your taxes. So, but getting the money from the employer is definitely better. So do that. But yeah, so can be done.
Okay. And then another question came in, Neil, because I feel like that was my question. Would you rather just take a 5K tax write-off or a 5K vacation with no write-off?
A 5K tax write-off.
Or a 5K vacation with no write-off. Which one would you take?
It's very apples and oranges. So I will tell you that, at the end of the summer, I'm going on vacation with the family, and there is no business purpose associated with it. So I'm just going to be out of pocket. And I'm not going to be checking email. I'm not going to be checking Slack. I'm not going to be doing anything. So I don't know if I've told you guys this yet or not, but
no. So we're taking notes now.
Yeah, it's probably going to be in September sometime. I haven't actually picked a date yet. But yeah, so I'll be gone for the week. And is that worth it? So am I costing myself? Yeah, I am, because I could do work and create a tax deduction out of it, but I don't want to. So there's that. So in real terms, and it's very subjective, right? So in my particular case, I'd rather have the vacation than the write-off. But I've also done a lot of other work to structure my situation so that my tax bill is not high, or not as high as it would be otherwise, in the first place. So, there's that. And that's amounts to a lot more than a 5K deduction. So, this really gets into the marginal utility of money. So, there's no absolute answer when it comes to how useful you find anything, right? Because everything's subjective and everything's marginal, meaning that, like, if I am sitting here and I have my bottle of water, I'm getting faded out. There we go, bottle of water. And it's like, how much would I pay for another bottle of water? Well, not that much, right? But if you're trekking through the desert and you need some water, how much would you pay for another bottle of water? A lot, right? Same bottle of water. So, your circumstances and your circumstances and where you are in life right now is going to dictate what you find useful for that next chunk of whatever. That's marginal utility. So the real answer to that is just, it depends on your situation. For me, at this point, with my numbers being what they are, I'll take the vacation.
Right. But that means you can't do any work, right? No work at all.
Yeah.
I don't know if you do.
Yeah, you guys are gonna figure it out.
Okay, that was it. Go ahead, Fatma.
All right, so we have received a question from one of our client boss. What is the best way to track expenses for tax purposes?
Yeah, I mean, there's a wide range of answers here. So the way I do it is I actually keep, obviously the business has a set of books, QuickBooks. I actually have a personal QuickBooks account, which is way overboard from whatever you need. So that's just because, I'm obviously in the business, and I have this kind of familiarity with this. In our Trailblazer toolkit that we provide for a lot of our clients, you can keep track of monthly totals of things fairly easily, where it breaks down a whole bunch of different categories, and you can say, okay, I spent 3,000 on this, I spent 200 on that, I spent 56 on this thing, and you just put it into the right category, and then that'll keep track. Now, the real answer is the way the regulations are written are that you have to keep track in some way. they don't dictate how you keep track. So I've had elderly clients who would bring me, so like, you know how in Excel or Google Sheets you have a spreadsheet, right? The term spreadsheet comes from an actual piece of paper that people used to use. And I had clients in the mid 2010s who would still bring me giant pieces of paper with a whole bunch of columns and a whole bunch of lines across and says, well, I totaled up this for this rental property and I've got income and I've got, and of course they're all wrong because people make mistakes doing arithmetic. So I have to go in and back check all the numbers and everything. Um, but but that is a way of keeping track, right? It's not a good way, but it is a way. So personally, I would say use a spreadsheet program. Could be Excel, could be Google Sheets, and if you just keep a general ledger, that's usually sufficient. So date, what the expense was, the amount, and what the expense was as far as description, and then you can have another note for whatever business or whatever purpose that expense had. So I'll give you a counterexample to that, though. Just today, I had a meeting with some reps from ADP, the payroll processing company. We met for lunch, and I paid for my own lunch, and I put it on my business credit card. And the documentation supporting that is going to be the event in my calendar, the emails coordinating that meeting, over the past week where we set the time and all that kind of stuff. And they're going to be emailing me some stuff probably tomorrow. And so all of that together creates the contemporaneous documentation that shows that this meeting had a business purpose. So if anybody were to ever ask, why did you expense this $12.59 for a sandwich and a drink at this cafe? I said, well, because I was having lunch with these people from ADP talking about payroll solutions and all this kind of stuff. So it was all 100% business, um, oriented, and that's my proof. And for that, that's perfectly sufficient, right? I don't need to then create another list with that same description and the amount and everything, because that information is already captured in those different places. Now, if somebody were to ask, it would be a pain to go dig those things up, but that's on me. That's the risk I'm willing to take. That if anybody were to ask about that particular expense, I can then justify it by finding those emails and finding the Google Calendar, reservation or whatever, and tying everything together. So, it depends. It depends on how comfortable you are. But the best single answer to that is just keeping a ledger, and a ledger is just an accounting term for a list of things that with numbers, dates, descriptions, and that's going to be sufficient.
Understood. It seems like there's a lot of independence questions here today.
That's pretty much all of them. Yeah.
Yeah. So I have another question that I don't think it depends, but
Okay.
someone wants to know, what's the deal with paying your kids? Is that just something rich people do, or can anyone set that up?
Well, anyone can set that up. Yeah. So when it comes to paying your kids, there's a couple caveats with it because I've seen people screw it up. So one is that they have to be direct employees of the parents. And what that means is you're either filing a Schedule C business or you're filing a partnership in which the partners are the parents. And if that's the case, then wages paid to minor children, so under 18, are exempt from Social Security and Medicare tax. They're also exempt from federal unemployment tax. And in most states, they're also exempt from state unemployment tax. And if you pay them less than whatever the standard deduction is for that year, which this year is $15,000, then they're not going to owe any income tax, because they're just under the threshold. So if all those things are true, then you could pay your kid up to $15,000 and be essentially completely tax-free. Some states you might have a small state tax liability. Kind of depends on how the state calculates their taxes. Some just go from the federal and then do adjustments. Some do their own starting point. So that depends a little bit. But either way, it's not significant. It's not a lot because state taxes are much lower than federal taxes. So if you set it up correctly, and the child is doing something, for business purposes again, then yeah, you can pay your kids, and anybody can do that. Whether it's worth it to you or not is going to depend on, you know, your situation. So a um, if you have a day job and no other business activity, then what are they doing? You know, because there's no other business activity. If you have your own business or even a smaller side business, then, you know, then there's potential utility there. And how much it saves is going to depend on what brackets you're in and how much you're paying, you know, however many of the kids that you have. We've had clients who have like 7 children, and they're able to, you know, between the age spread, you know, because, you know, the younger ones do less valuable work than the older ones, but they're able to, you know, utilize that extensively. And, you know, so there's caveats with it, like everything. There's rules to follow, but as long as you follow those rules, then yeah, anybody can do it, assuming that it's actually of use to you.
Understood.
Yeah, so for my next question, boss, is it better to buy something big for your business at the end of the year for a write-off, or does that not always work?
Yes. No, it works. So if you go on YouTube or TikTok or whatever, you'll see these guys selling planes, right? It's like, well, here's what you do. You buy a $30 million plane, and then you finance 80% of it, and then you get the write-off on the whole thing. That's all true. So it does work in the sense that if you buy something really expensive, you can write off at least a portion of it, you know, on your, again, related to business stuff. Um, but I caution people to not let the tail wag the dog, right? Getting the write-off is not worth getting into an enormous expense unless there is a real purpose for doing that, right? So if you're in manufacturing and you buy new manufacturing equipment that you're going to use in the upcoming year, then absolutely, right? Because that's a productive asset that's going to then generate more income, right? If it's a plane or a boat or whatever, that is, you know, it's like, yeah, if you squint at it hard enough, you can make it work. You know, just realize that you're you're obtaining massive liabilities. Even if you pay cash, you're obtaining the liability of all the maintenance that goes on with those things on into the future. And, you know, the brokers always tell it's like, oh, you just resell it at the end of it, you know, and you'll get your money back. It's like, yeah, okay, not all the time. You know, they say, you know, what boat stands for is break out another thousand. You know, it's a hole in the water that you throw money into. You know, these are truisms that people who have owned boats are aware of. So, you know, it's it's a dangerous strategy. So it does work because whatever expense that you incur, and, you know, maybe you have to depreciate, maybe you don't, depending on what the thing is. But if we get 100% bonus depreciation back, then it doesn't matter because you can expense it all in year one anyways, et cetera, et cetera. You know, if there's not a real purpose behind that purchase, then you are, you know, shooting yourself in the foot to avoid taking a punch to the face. It's like, yeah, you didn't get the punch to the face, but you still shot yourself in the foot. So, you know, was that a wise strategy? Maybe. You know, depends on the punch, right? So, so yeah, you have to just be very mindful of that, and be aware of what you're doing and what you're buying at, you know, when you go for those big purchases at the end of the year. But yeah, like all the car dealerships and everything, they love the end of the year because all the business guys come and say, I gotta spend 80 grand. What do you got?
Ah, I didn't think of that.
Yeah.
Makes
So
sense.
2 cars ago, I bought or I actually leased a new car, and it was in December. And the guys were telling me, it's like, oh yeah, yeah, you know, all you guys come in at the end of the year, you know, trying to get these things on the books for this year. It's like, well, that's not my purpose, but I actually needed a new car and was doing the whole business credit game and all this kind of stuff. So that was a fun experience. But yeah, so it does work. You have to be mindful of the category of thing that you're doing and make sure that there is a productive use for that machine or whatever that you're buying in order to produce more income in the future.
Alrighty, so we have a self-employed question.
All right.
Someone wants to know when someone is self-employed and they don't pay quarterly taxes,
Mhm.
what's the real damage?
So it's a good question. The real damage is the underpayment penalty. and that's going to fluctuate. It changes every quarter. The IRS releases a new rate depending on the interest rates, and so right now it's 7%. So, and it accrues from the time of the missed estimated payment to the time of filing. So we just had the Q2 filing. It's going to be roughly 8 to 10 months between now and the actual tax filing. So you're accruing daily at a 7% annualized rate from now until then. And so, how much does that matter? It's like, well, I mean, it matters. It increases your taxes by potentially an extra 7%. But how much value does that cash have in your pocket versus in the IRS's pocket, right? Because I mean, the real reason when it gets down to it is that you are paying the IRS in order for them to not charge you extra at the end, right? And so, depends on what you're making on that money, right? So if you use that money in your own business and you turn that, let's say $1,000 into $2,000, well, then absolutely do that instead of paying the IRS the $1,000 and not making the extra 1,000, right? So it depends on what your use for the money is. Depends on how risk averse you are. I've had clients who say, who don't want to take deductions that they're even entitled to, just because it's like they would feel like they would increase their risk of audit. It wouldn't, but some people feel that way anyways. And if it keeps you up at night, then do whatever payments you need to make in order to allow yourself to sleep at night. But if you are more on the aggressive side and you want to say, I want to maximize the use of my cash in order to grow my business as fast as possible, and I'll deal with the extra penalty at the end, then okay. That's a choice you can make. We're just here to advise about the different outcomes of different situations, right? So as long as you're educated on the pros and cons of each approach, then I'm good with whatever. So yeah, that's the real outcome is a little bit extra tax on the end, and again depends on interest rates, because I think it's prime plus 3 is the calculation, is the way they do it. But either way, they revise it every quarter, and as rates change, they'll change that 7% rate. So yeah, that's the upside and or downside of not paying. Now, if it gets to be an extreme level, they can do forced withholding. So that's the thing that's mostly for W-2 people. So I've had people who work at a company where their HR systems allow them to manually go in and adjust their withholdings. So some people put themselves as exempt for the whole year, make $100,000, and then say, "Oh yeah, I owe taxes. I forgot about that." And in those kind of situations, the IRS can come in potentially and force withholding on the employer and say, "Hey, no matter what this guy says, withhold max amount on him as though he were single." And that's mostly men who do that for whatever reason, in my experience. There's definitely a different risk profile between men and women. But yeah, so that's the upside and downside. With that, I think we're coming to the end of time here. I know you guys have a call to jump to. So for anybody watching, if any of this is useful to you or you have additional questions, just email us at office@taxsherpa.com. That goes to Fatma. If you email me, it also goes to Fatma, as by the way. I know we have a meeting in the morning. She says, "Here's the things you need to look at." So it's I'm not the Johnny on the spot when it comes to emails and whatnot, but Fatma is. That's why so much she works here. So yeah, so if you have questions, send them in office@taxsherpa. If you want a copy of the checklist, the self checklist, same thing. Just email us. We'll send it to you, and we'll do this again next week. Next week is the 24th, right? Do I have anything weird going on next week? I don't think so. Let me just take a quick look while we're here.
Yeah, it's 24th.
No, I don't see anything on my calendar that would interfere, so we should be good. All right. Thanks, everybody.